Let's do it, folks. Good morning. Welcome to the show. This is the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Friday. Yes, Friday, as some people like to call it, the 14th of October. How are we already in the middle of October? I'm your host, JD Durkin. Opening bell rung right here on the floor just a moment ago by Lux Capital. You may have woken up this morning with a little bit of a pain in your neck after all the whiplash in the markets yesterday. Good luck if you were trying to day trade. Big positive pre-market buys predicting ahead of the CPI data yesterday, then hotter than expected CPI numbers that led to a significant sell-off to begin the day, only to be kind of shrugged off within a few hours for an intraday dominant session. The S&P finishing up 2.6% to snap that index's 6-day losing streak. The Dow finishing up 2.8%. Tech-heavy NASDAQ wrapped up in the green, 2.2%. For the Dow specifically, it was a 1,500 point swing from its low to its high. What will Friday bring? Just a moment or so into the trading session here, the S&P up to a fast start, 0.7. The Dow up in the green, 0.6. We have no idea what the day is going to bring, but that's why we're here. And with all that said, let's now turn our attention to what is on tap for this morning's broadcast. We will be breaking down the wild day that was, and possibly could be once again here in the markets. Plus, in a week of 1 million data points, we get a few more to chew on, including retail sales. If you've been watching our broadcast throughout the week, you know we've been very hyped for Friday's retail sales data. We'll tell you everything you need to know. Plus, the big banks rounding out this first week of earnings. And for more insights into these stories and so much more, let's now bring in our senior editor and markets correspondent, Mr. Martin Baccardax. Martin, so much to chew on for today, but I would like to get your impressions on a wild day yesterday. We just broke down where some of the indexes finished up after really being very down for quite some time. The conditions are not there for a Fed pivot, but what helps explain the afternoon huge turnaround that we had yesterday?
It was an extraordinary session, wasn't it, JD? And I think it's interesting because you and I were speaking prior to the turnaround yesterday, and we were both a little bit confused as to why the market would sell off from inflation data that was pretty much what we had anticipated would come. And of course, it didn't really give, as you suggest, any evidence for a Fed pivot. So the conditions for a surge were really not there, but neither were the conditions for the kind of sell-off that we saw either. I think what materialized yesterday more than anything else was just some technical factors in the marketplace where you had a host of NASDAQ stocks that were trading well south of their 52-week lows. You have investment firms around the world which are sitting on significant amounts of cash, saw some value opportunities in a market that wasn't going to be surprised by inflation data anymore. If there's one thing that longer-term investors prefer more than anything else, it's certainty and clarity. And perhaps you could argue that they did get that from the inflation data and from the Fed minutes the day before. So once they saw those technical levels breached, they were able to pile in quickly and scoop up some undervalued stocks, or at least stocks that they considered to be undervalued based on their individual metrics. So I think that was probably the precursor to the rally, and then it just began and gathered momentum throughout the session. But as you described, a trough to peak rally for the Dow of about 1,500 points is the best that we've seen in a little bit more than 2 years, and the single day point gain was one of the best of the season as well. So it was a pretty impressive stretch, I think, for U.S. markets, and we're extending it again today on the basis of earnings, some merger deals, and some positive comments from Russia as well. So ultimately, this is relatively solid conditions and perhaps even more robust than I first anticipated. But I think your earlier point is probably the best one, JD. We didn't get any surprise from the Fed with respect to a reaction function as a result of the CPI data. And that was probably more than anything else in pairing with the technical levels as to why we saw that rally yesterday.
Yeah, we'll get to that Russian news in just a moment because that just wound up in our inboxes there as well. But for people that tend to, maybe they're day traders, they tend to follow the major market indexes, Martin, day to day very closely. Oftentimes there could be a little bit of news that breaks in the middle of the day that helps jostle you off the path you're on. Maybe Fed Chair Jay Powell comes out and says something that makes you say, uh-oh, that's not what I want to hear. Was there anything like that yesterday? Is there anything specifically you could point to at a certain window, or did the dust just kind of settle a few hours after the data came out, I wonder?
Yeah, not particularly, JD, but I think the question is still incredibly relevant because what has dominated market trading over the past maybe 5 to 7 years is something that's been described as algorithmic trading. And I'm going to condense this down to the simplest form that I can, and I'm going to be missing some big components of it as I do so, but bear with me here. Essentially, with an algorithmic trading program, what you have is a whole series of complicated mathematical functions that will trigger buy and sell orders based on, again, all of those metrics, but triggered at the end of the day by keywords that come through in news headlines. So in other words, when you have news providers such as Bloomberg and Reuters and Dow Jones and others setting out these news headlines based on events in the marketplace from governments, from companies, and everything else, the various words will trigger buying and selling in the algorithm. Now, that means that very often the program trading will kick in first, and then when the human trading comes in afterwards, you end up getting these either big jumps upward or downwards that are quickly corrected as a result of maybe humans anticipating or seeing what actually was the case in terms of the news event, as opposed to just the keyword trigger. So I think yesterday what happened was the keyword triggers from the inflation data, which indicated hotter than expected, faster than expected, higher than expected, ultimately led to the stocks trading down in the beginning. But then when humans and fund managers began to take over the trading day, they saw that because there wasn't that kind of inflation surprise and it wasn't going to change the what they already understood to be the reaction function from the Fed, they were able to buy stocks as a result. And of course, the technical factors that we laid out earlier in this program were also in play. So I think that's probably what resulted in yesterday's swing rather than a significant piece of information. It was more about the fact that once the program trading ended and the human trading began, there was a better context for what we saw in the data, and that's probably what drove the market rally yesterday.
That is about as comprehensive and as good faith an explanation as anyone will see on any TV channel at all, and it is very difficult to go through everything that you just did. So I appreciate it. And again, you know, when we do these morning shows, we don't typically, you and I, Martin, we don't typically talk about the previous day. On rare exception, from time to time, you and I will, if there is such a remarkable day of trading, the likes of which we had yesterday. So I appreciate you being willing to start off today's show by looking at yesterday, even if yesterday, especially if yesterday helped set the stage a little bit for today. Let's now turn our attention to this Friday, or this Friday, as some people like to call it. What is top of mind here? Obviously, retail data came out here before the bell. We'll get to earnings in just a little bit. I wonder what specifically on the retail side or other general market stories are helping drive some of the conversation a few minutes into the session today for you, Martin.
Yeah, there's a little bit of perversion sometimes in the numbers, JD, particularly in markets like this where bad news is seen as good news. So essentially, if we're looking at September retail sales, they were flat to August. August was revised up modestly higher, but we really didn't get any gain in terms of retail sales at the nominal level. Largely because of two conditions, I think. The first is that the deceleration in gas prices has held down that nominal number, which isn't inflation adjusted. And secondly, the fact that the deceleration didn't spike a jump in discretionary spending probably is indicative of the fact that consumers are pulling back on spending as a result of the headlines they see on CPI, job losses, and everything else. So without a kind of without a lift, if you will, from the consumer heading into the final months of the year, the Fed might be seeing some of its activities bearing fruit. They want to slow down the economy. They want to cool down spending, inflation, and the job market, as challenging and as grim a task as that might be, in order to ensure the longer-term prospects of the world's biggest economy. So whilst I think some people have been hypercritical about the Fed's ambitions and sort of characterizing it as wanting to kill the job market or kill the U.S. consumer, I really don't think those are fair. They are tasked with this rather unenviable job of having to slow the economy just enough to ensure that inflation comes down, but not enough to choke off growth and tip us into recession. That's a delicate balance to strike, particularly when you're looking at all those geopolitical stresses that markets have to face, and indeed consumers have to face at the same time. So I really feel that the fact that we had that flat reading for retail sales alongside the rally yesterday is probably why we're getting another lift again today.
And then give us some sense on what retail sales either traditionally look like, or maybe any expectations, because soon enough we'll be having this conversation. It will be months like November and December, and I'm curious what expectations we typically have. We're obviously in we're in a year and an economic cycle that you can't really compare to very many cycles, but what do we traditionally see with retail data as we push a little bit closer into the holiday season, Martin?
Yeah, it's a great question. I think there's a lot of components that aren't necessarily repeatable, which are probably going to give us maybe a little bit of uptick heading into October. The impact of Hurricane Ian, for instance, which hit the Florida coast at the end of September, not only had a bit of a bump in terms of people stocking up in anticipation, but probably going to increase sales afterwards as people, go through the grim task of replacing their lost items and rebuilding their lives after that devastating storm, one of the worst in 50 years. I think we're also probably going to see a jump in car sales as a result of the unsticking, if you will, of global supply chains, which have held back inventories for some of the big OEMs. We're going to see probably an increase in used car sales as prices decline. And as we've talked about earlier this week, JD, we've seen Walmart, Target, Amazon and others bring forward their holiday sales in order to make sure that they capture consumer demand while their personal balance sheets are still flush, because there's quite a bit of data out there that suggested Americans are near to the end of running down their pandemic era savings. And if the job market were to turn in the way that the Fed wants, in other words, if it is going to get a little bit weaker heading into the end of the year, consumers are going to pull back on spending even further. So if you were to ask me where I feel the direction of spending is going to go, I'd probably say short-term relatively solid, but medium-term a lot more questions about the strength of the American consumer.
Anything else here specifically on the intersection of retail figures and inflation that you think is important for people to keep in mind? And I always like asking you questions like that, Martin, because you file stories so frequently. Every single morning you're up very early doing these stories, and I wonder if there's always parts of the equation that you say from your perspective, people oftentimes forget this really important fact. Is there anything like that in these stories that as you hear other people talk, you say, you're oftentimes forgetting, popular conversation is forgetting some really important parts of this of the story?
I think a lot of it has been told properly, JD, to be perfectly honest with you. But if I were to find one nugget inside of all of it, I'd probably go back to the decline in gas prices, which is slowing significantly. We had big slumps over the summertime from that record high of $5.10 per gallon in June, and we got all the way down to about 283 or 284, I think, on a national average at the end of September. But now we're bumping higher again, and oil prices are starting to hold at those post-OPEC production cut levels, despite the fact that we're seeing weakened economic growth around the world. That tells me that we're probably not going to get the sort of a tailwind of spending as a result of cheaper gas prices, because they're either going to stay the same or maybe even continue to rise between now and the end of the year. I don't think there's an appetite from the administration's point of view to tap the Strategic Petroleum Reserve in order to bring down oil prices. I think it's simply too late for that. So we may end up having to work around that sort of slowing tailwind of lower gas prices in the months ahead. One thing I think that might be worth adding to that, JD, is the fact that I was struck by a piece of data this morning out of China, which showed that actually their consumer prices are running at the fastest rate in about 2 years. And that's an interesting dynamic because inflation there is far more based on food prices than energy prices. So that's something I think that the government is going to have its eye on. But underneath that, JD, their factory gate inflation actually slowed to the slowest pace in just over a year. That's super important, obviously, because we have, I do beg your pardon, we are so reliant on imports from China, as is most other economies around the world, that we have been concerned about them exporting inflation for the past few months. But if their factory gate prices are falling, they are going to be exporting goods at lower prices. And that, of course, is going to ease our input inflation at the same time. That may give us some relief on the inflation point, and as a result, give us some relief on the consumer spending point. But that's going to take a few months to materialize. Nonetheless, the early seeds are there, and I thought that piece of information was interesting for sure.
I appreciate the perspective. Martin, I do want to get your reaction because you did mention Russian President Vladimir Putin and a bit of news out of Russia a short time ago, and this broke just before the opening bell here on the floor of the New York Stock Exchange, and a bit of pre-market movement perhaps in the S&P off of these comments. This is Putin saying that a direct clash of NATO troops with Russia would lead to global catastrophe, saying Russia is not seeking to destroy Ukraine. There's no need for massive strikes against the country on Ukraine, and a few other comments like that that might suggest just to investors that perhaps there's at least maybe not a change of position is the right way to phrase it, but at least showing, Putin is at least putting on a face right now to say any severe military action right now, it does not appear to be the priority. I think that's a good faith read of it. On the one hand, do you ever trust a person like Vladimir Putin with what he says? But on the other hand, there did seem to be a little bit of pre-market movement. I'm just curious your perspective on, how you view an investor reaction to comments like that, especially from someone who, quite frankly, objectively cannot be trusted, like President Putin.
It brings back the old phrase, doesn't it, JD? Trust but verify. I think we're probably best to have to verify statements from Vladimir Putin first before we're prepared to trust them. But if we can at least take him partially at his word, I think the one thing the comments could do is neutralize one of the key geopolitical concerns for the market right now. And that, of course, is the escalation of military activity in the Ukraine and Russia's involvement in it. They've talked about, the Russians have, slowing down the mobilization of troops. And the suggestion is they aren't going to accelerate that going into the end of the year. And that's certainly good news. But that conflict is going to remain entrenched for a number of years, I should imagine. I can't see a scenario in which Putin is able to extract himself from that without a humiliating defeat, which would, of course, probably mark the end of his tenure as leader of the Russian government and indeed the Russian state. So that doesn't seem to be on the cards for me. But nonetheless, if he is able to find a long-term solution that will allow him to save face whilst also retreating from those annexed territories, that might be the best situation in the long term. As a result, we can probably look at the potential for neutralizing that impact on the global economy and indeed the European economy. But as you alluded to earlier, this is a case of where we simply can't trust the words on face, even though they do seem to be heading us in the right direction.
Yeah, it's incredible because you listen to comments this week made by Jamie Dimon, by virtually every business leader, if his or her sector or work directly involves, if they're a multinational corporation especially, the idea of geopolitical tensions is always invoked in every response. We talk about potential headwinds for the future. They say, well, of course, there's geopolitical tensions. That oftentimes is shorthand. If they don't otherwise explicitly say Russia's war in Ukraine, that is largely what they are referencing. And so you see that as a top priority for a lot of CEOs and business leaders, both at home and certainly abroad. That's a part of the story we'll continue to follow, and I appreciate your perspective. Martin, you also filed this morning talking about the big banks, because we got earnings palooza is here. Jpmorgan Chase and Wells Fargo both topping expectations. Let's start with those two names, specifically Morgan. What do we see there out of those two?
Yeah, it was a similar theme across the board for Jpmorgan and Citigroup for sure. They had big declines in their investment banking division, but that was offset and more so by what they had in net interest income gains. And that's really a fancy way of saying that the banks are in the business of borrowing cheaply and lending expensively. And they, of course, gather profits from the difference between the two. And the fact that you have these increases in Fed funds rates, and of course, we've had three of them so far this year, and a fourth coming up in November, we've had an increase in the base borrowing costs that banks have been able to pass on to their customer base as a result. So we have massive gains for net interest income for Jpmorgan, for Citigroup, and indeed for Wells Fargo. And that has been a great earnings driver because it's been able to offset what I've described as a decline in investment banking fees. It's been a terrible quarter, JD, for mergers and acquisitions activity. It's down 55% from the same period last year. The total number of deals is just under, I think, 700 billion, and that's one of the lowest totals we've seen in a little bit more than 2 years. And in fact, the year-on-year decline in deals, JD, is the biggest that we've seen since 2009. So the market turmoil, the increase in interest rates around the world, not only from the Fed, but the Bank of England, European Central Bank, and others, has basically put a hammerlock on deal making this year. And that's hived a lot of investment banking fees. So I think investors were rather surprised that banks were able to pass on their cost base to customers. And this is something we've talked about on a number of occasions this week, JD. Investors like companies that have pricing power. And at the end of the day, there's probably no sector that has greater pricing power than the banks, because none of us can do anything without their help. So I think that's probably the underlying theme that we're seeing, not only in Jpmorgan and Citigroup, but Wells Fargo as well.
And Jpmorgan Chase specifically more or less still the overall bellwether for the banks itself. Obviously, if banks are what we most closely follow in terms of the economy, is Jpmorgan Chase still the top dog, if you will, of the banks, which is, I would assume, underscoring the importance of those numbers today.
Yes, I'd say so. The biggest U.S. bank, of course, and their fingers are just about in every pie that we see in the American economy, from mortgages to investment banking to advisory, and really just to day-to-day banking. So I think those numbers are incredibly instructive. And Jamie Dimon, the CEO, knows that, and he is very, as a result, I think, calibrated in his public comments. He talked about the headwinds to the global economy, the one that you alluded to earlier being the most significant in terms of Russia's war in Ukraine. But he's also mentioned the surge in inflation, the fact that central banks are going to be accelerating their rate hike efforts in order to tame it, and of just the broader global macro uncertainty with respect to the risk of near-term recession that has been articulated this week at the International Monetary Fund meetings in Washington. But he was also relatively praiseworthy of the strength of the U.S. economy and the fact that consumer balance sheets, in other words, the personal financial situations of the Jpmorgan's bank customers, was relatively robust, and he was liking the fact that retail sales were holding up. He hadn't seen, obviously, the September numbers, but they weren't terrible. They were just flat. So I think ultimately, whilst he's describing some of these externalities, as economists might describe it, in terms of risks that are outside the U.S. control, he was reasonably effusive about the underlying strength of the U.S. economy, probably as a result of the tight labor market. And that might just be the magic antidote for avoiding recession. So I was interested to read his comments. I'm going to go more deeply into them later today, because I think he is essentially standing at the bow of the ship of the U.S. economy, and it's always worth getting the opinion of somebody who has that kind of vision.
What is the overall outlook for earnings season? I don't just mean specifically here with the banks, but obviously this was the first week really in earnest that you and I had several opportunities. PepsiCo, Delta, the banks here today. I mean, we're back in full swing more or less. If we're not now, we will be in the weeks ahead. It's not the most optimistic of overall outlooks, however, is it though, Martin?
No, ultimately, prior to today, and there might be some recalibration of these estimates as a result of the better than expected numbers we saw, not only from the banks, but also from United Health, which boosted its profit forecast for the third time this year. But prior to today, the anticipation was for collective S&P 500 earnings to rise by about 4.1%. That would take the bottom line total to about $684 billion. The difficulty is, JD, that once you strip away the energy sector, which is the lion's share of the gains, earnings are probably going to be down by about 1% from the same period last year. So that doesn't really speak to robust profitability. But those numbers are going to improve into the fourth quarter of this year, at least according to the estimates prior to today. And as I say, that might be bumped up, as might be the anticipation for Q3 earnings as well. And I'll be interested to see where we go next week, because we have a lot of numbers across the board from various sectors, including Tesla, Johnson & Johnson, AT&T, Goldman Sachs, and a bunch of others. We won't get the big tech earnings until the following week, and that will ultimately, I'm certain, be what dictates market direction. But if we're looking for overall profitability and health scorecards, we're probably going to get them next week and beyond. And I think those might end up being a little bit firmer than we were first anticipating.
They'll give us no shortage of fun things to talk about here on the show every morning, Martin, as I read through the headlines, and I will feverishly ask myself, what does this mean? I'm going to ask Martin in just a little bit, because that's what I do every morning. Okay, time now for our rapid fire section here on this Friday, the last one of the week. Let's see what we have in store. First up, let's go shopping. Kroger and Albertsons are set to merge. Does this pose a bit of an antitrust risk? Martin?
I think it might, JD. I think it's a fascinating deal. It's worth about $25 billion on face, but it's going to create the biggest standalone grocery store in the United States. They're going to have around 5,000 stores and annual revenues of more than $210 billion. That is enormous. And put it into context, JD, that's well ahead of the about $143 billion that Costco sells in groceries every single year. And Costco is the third largest grocery store, which of course doesn't just rely on groceries, but nonetheless. So I do think there's going to be some antitrust concerns about this deal. I think that Kroger alluded to it in some of their commentary about how they said that Albertsons stores don't necessarily overlap with Kroger's. But I do wonder if the U.S. government, particularly the Federal Trade Commission, is going to look at this deal, see it in the context of the fastest food price inflation since 1979, and see it as limiting rather than expanding consumer choice. We're not seeing Albertsons shares move closer to the 34.10 mark that Kroger has promised to pay for it. So I do wonder if that bakes in some of that antitrust concern. But nonetheless, I would imagine this is going to be a big shakeup for the grocery market and a bit of a shot across the bow with people like Walmart, Target, and Amazon who have moved into that space over the past few years.
Certainly will be a shot across the bow there. Okay, number 2, Beyond Meat announcing layoffs. How concerning is this, Martin?
The hits just keep on coming for Beyond Meat. The stock is down about 80% so far this year. And I do think it's a bit of a shame. I mean, if I could editorialize, JD, I really like the products. I think the food is excellent, but I do think it's probably high priced, particularly in a market where we are suffering food price inflation and people are pulling back on discretionary spending. Beyond Meat basically conceded at least a portion of that, saying macroeconomic conditions are going to hit its full year sales. They cut their guidance for the second time in about 4 months. They only see sales rising to about 400 to 425 million this year. They're going to cut about 20% of the workforce, and some senior people are going to go, including the company CFO, and he's only been there for less than a year, JD. So they're really trying to rearrange the deck chairs on this company and get it into the right position in order to capture demand going forward. I think ultimately they do have a good business proposition, but the price point right now is simply too aggressive, and the company has just been too chaotic in managing some headline risks over the year. So it's one to step away from, but probably one to look forward to in the coming years.
See, this one pains me as well, Martin. I just personally, I would love to see a company like Beyond Meat and have these plant-based offerings be out there on the market, but obviously it has suffered a lot of kind of ill fortune here, and those challenges, those headwinds will continue for Beyond Meat and others in the space, especially right now. Okay, number 3, will the UK scrap its tax plan? Yeah, please fill me in about what's happening here.
Oh my God, it's absolute chaos in the UK. Prime Minister Liz Truss has now the lowest approval rating in history in terms of UK political leaders, surpassing only that of John Major in 1994. For those who are paying close attention, shortly after that case in 1994, John Major lost to the Labour government and the Conservative Party was out of power for the next 13 years. So there's huge stakes at play now for Liz Truss. She has sacked her finance minister as a result of the U-turns that they're making right now in terms of tax cuts, borrowing increases, and their anticipation of the fuel crisis heading into the wintertime. So the expectation now, JD, is that she is going to announce more U-turns and potentially even possibly raising corporate taxes in order to fund some of her growth ambitions. But she's already pledged not to make any changes to public spending. So no one is entirely sure exactly what the cohesion is in these economic plans, or if there indeed is one. So as a result, again, as we talked about yesterday, I really think there's going to be electoral pressure in the coming weeks. I'll be terribly surprised if she's able to survive into the next year. And this is ultimately going to lead, I think, not only to a political crisis in the UK, but a potentially deepening of their economic woes. And I think that's really why we're seeing such turmoil in the gilt market and indeed pressure on FTSE 100 stocks too.
Absolutely. Okay, finally, I've wanted your perspective on this one all week. What is on tap for the National Football League's 6th week of the season? How's it already week 6? We're already into bye week territory. What are we looking at, Martin?
It's an amazing, I'm really looking forward to this game on Sunday afternoon between the Buffalo Bills and the Kansas City Chiefs. I think that's the marquee matchup of the weekend, with Josh Allen and Patrick Mahomes going head to head. I was surprised to see that the over-under for points scored in the game is about 53.5, I think, the last time I looked. I think it's actually going to be higher than that if they're both let loose. And they probably will be, given the fact that the referees are so sensitive about sort of protecting quarterbacks in this league, which is growing, increasingly a difficult challenge to do so, if I were to put it mildly. So that one's going to be a lot of fun. Just two tremendous athletes at the top of their game going head to head. I think Buffalo is actually the favorite, even though they're traveling to Kansas City. So that would be an interesting one to watch. And you stay with quarterbacks, JD, don't you? I mean, we're looking at whether we're going to have Cooper Rush staying at the helm for the Dallas Cowboys when Dak Prescott comes back, whether or not we're going to see this new kid, I think it's Zappi, am I right, JD, for the New England Patriots. He's playing very well in replace of Mac Jones. So it's quarterback controversies all over the place, whilst at the same time, nobody knows who's good and nobody knows who's bad, because I think if I were to look at the numbers right now, I'd say about half the league is playing at around 500. The parity that the NFL has been able to construct as a result of its salary cap and anything else is just amazing, and it makes every week incredibly valuable and incredibly entertaining.
I think we do know the teams that aren't good, and they have tended to be the teams playing on Thursday Night Football the last couple of weeks, because last night was a snooze fest. I'm sorry
it really
to
was.
my friend and our friend Ross Mack, who does a lot of content for us here at The Street, loves the Bears, and he and I were texting yesterday. But my goodness, that was a pitiful performance. It just in terms of a game to watch, you're like, neither team wants to win this football game. We all felt the same about the previous Thursday night. But then we have other games, like this is the Raiders-Chief game on Monday Night Football, was an outstanding football game. Yeah. So sometimes the primetime games that are nationally televised can be total clunkers, or they can be absolute must-watch games that keep you up way later than you should be. And I love talking about football with you. And your Finns have... who do Dolphins have this week? Oh, Vikings. How are you feeling about that? Minnesota, Miami?
Yeah, I'm not feeling great, to be honest, JT. Our quarterback is still, suffering from the potential head injuries and certainly the back injuries that he felt over the past 2 games. So he's still going to be sitting out. I think our season is in significant jeopardy, and ultimately, I think questions about Tua's ability to play in this league, given his slight stature and the hits that he's already taken. And remember, he had hip surgery as well prior to his entry into the NFL are significant. So that's a little bit worrying to me. But I really like your point about Thursday Night Football, JD. I wonder if we can put our conspiracy theory hats on and wonder if the fact that these rather unentertaining games seem to be sectioned to the Thursday night slate, which, of course, only happens to be the propriety of Amazon.
Right. Well, originally the schedule looked actually pretty good, and I just took a look at some of the next few Thursdays. They are going to put Tom Brady and the Bucs there in Week 8. That's a good game. The Eagles will be playing in Week 9. That's obviously an outstanding game because Philadelphia couldn't lose if it wanted to right now. And the games kind of have a little bit of a hit or miss thing. We'll get the Packers there playing Week 11. You see, but I feel part of the goal here is to put really good games on Thursday, you would think, to encourage people to get used to watching the Al Michaels, Kirk Herbstreit broadcast and the team there on Amazon. It just so happens these last couple of games have just been like please end. Please let this football game come to a close. That's how I felt watching them.
Well, I think that's interesting, JD, because I thought I saw a stat over the weekend that said the game that was in London at Tottenham Hotspur Stadium between the Packers and the Giants was the first time that both teams had a winning record when they played in London. So it's interesting that whilst they have tried to expand the game in Europe, and I've gone to several games in London, and Wembley has had about 85,000 fans there as a result, and people from not only Britain but all over Europe. So I think there's tremendous potential there. But it was interesting to me that was the first time that 2 teams with a winning record were playing one another in the London matchup.
And to be fair, the Giants were never expected to have a winning record heading into this week, so largely they probably put the Giants there. Okay, so wait, so were you there at the Dolphins-Giant game years ago? That's like 07-08. Giants played. Eli Manning scrambled for a touchdown. That was in Wembley. I don't know if you were there for that.
It was in Wembley. It was pouring rain.
I was there
with one of my very good friends, not under the canopy, unfortunately. It was freezing cold. It was a Sunday night, and I'd rather catch forget it.
All Giants fans love that game because it was a rare moment where Eli Manning actually scrambled for a touchdown, ran it into the end zone himself, and the fact that we can remember that tells you how infrequently it happened in the man's otherwise Hall of Fame career. I love the London games, and I love talking about this and all the important stories with you. Martin Baccardax, thank you for taking the time today. Enjoy the Dolphins game and enjoy another great weekend of NFL football. Martin, thanks. We'll do it again next week.
Thanks, JD.
You got it. All right, that's going to do it for the Market Open here from the floor of the New York Stock Exchange. Stick with The Street for more on these and all of the major market stories that matter to you. We'll see you Monday.